Hello, I'm Granger with Hughes Retirement Group. I wanted to kind of do a follow-up video on the 3 buckets of money where we talked about taxable, tax-deferred, and tax-free. And the reason I want to talk about this because it really ties in, and when we're dealing with our clients, this is something we really try to stress as we're moving towards that age of required minimum distributions of 70 and a half. So if we take a look right here, I've got put up here Social Security tax and the provisional income formula that we're going to kind of take a look at. A lot of people don't realize that when they go to retire, you hear a lot of people talk about making as much as they want once they've reached full retirement age. And right now that age is 66 for those people who were born 1954 or sooner. And that is true. You can make as much as you want, but it doesn't mean that you're not going to pay taxes. So let's dig a little deeper here and take a look at how paying taxes on Social Security could impact you in retirement. And I put up a hypothetical example here, and we'll kind of play with those numbers. So something to take away here, when we're looking at this provisional income formula in retirement, some key numbers that we need to look at are $32,000 and $44,000. So if you're married and filing jointly, once you make over $32,000 a year, your Social Security becomes 50% taxable. If you're married and filing jointly and making over $44,000 a year, 85% of your Social Security becomes taxable. So what does that mean? When we take a look at this example here, if you had a pension of $40,000, Social Security of $40,000 combined, and then your required minimum distribution, those are those accounts that the government makes us take money from, our tax-deferred accounts, our qualified retirement plans like 401ks or traditional IRAs, we have to take money from those accounts. So in this example, what we're looking at is this pension plus Social Security plus RMD is going to take us up in income. But something that the federal government does is they only count 1/2 of your Social Security in the provisional income formula. So when we actually add this up, we won't add 40 plus 40 plus 30. We'll add 40 plus 20 because that's 1/2 plus 30, which is going to give us $90,000 in income. Obviously, we know that $90,000 is greater than $44,000. So what that means for you is if you're over that $44,000 threshold, now this $40,000 becomes 85% taxable. So $34,000 of Social Security income has now just become taxable. So we talk about future tax rates and what will those be as we get towards retirement or in retirement. But hypothetically, let's go ahead and say if we're making 90,000 and we were to be in a 25% tax bracket, what kind of tax is that going to mean for us? Now all of a sudden we've just added an $8,500 tax in just Social Security income. So one of the things we stress when we're talking with our clients is over the course of 30 or 40 years, however long your retirement may last, you may spend upwards of $500,000 or $1 million in just Social Security taxation. So we really press upon our clients that it's important to have our money in the right buckets of money. And if you watch the prior video about the taxable, tax-free, and tax-deferred buckets, the more money that we have in tax-free, the less we have to take in RMDs. So if we had $1 million in a Roth IRA or a Roth conversion, we can take that money out without having to pay taxes. So it's very, very important as you're transitioning towards those retirement years, transitioning towards those distribution years. Now you're not contributing to something, you're distributing from something, that you've got your money positioned in the right bucket to avoid paying unnecessary taxes and Social Security.